All right. Hello. Hello. Okay, I think they're going to hear us now.
Hopefully everybody can hear us. Might get a comment on the live chat. We'll see. Anyway, we'll carry on and we'll assume that everyone can hear us, Patrick. Oh, someone said can't hear you. Okay, working on it.
Testing. Go again, Kevin.
Okay, I'll just. Oh, yeah, they can hear us now. Thank you. Thanks for letting us know. That was Dominique, I think it was, that let us know. Okay, Patrick, over to you.
All
Or
right.
was it over to me?
Well, guys, catching up again with Kevin, and that strong move there for silver out of that base kind of like morphed the charts, and everything went by so fast, and now people taking profits. When's the next correction? And Kevin had a great idea to just see where we're at right now, recap the weight of evidence that was piled up before. So all you guys that just starting in the silver bull market, you'll see all the evidence that Kevin built over the years. And then we're going to grind to where we are today and the possible scenarios, and also probabilities of those possible scenarios where they're heading going forward. So this is a great presentation that Kevin put together, and all the questions, keep them. We're gonna the live chat. I'll try to answer them while Kevin's talking, but I still have to. I'll listen to Kevin, and at the end we'll respond verbally to any of your questions you have, and maybe go and do interactive charts there if it's possible. PM, precious metals. So Arnold, maybe you're new. Me too. I didn't know that those initials. So PM is precious metals. Do you have control of the mouse, Kevin?
I think I probably do, Patrick. Yeah, we'll find out in a minute anyway.
Okay.
Okay, well, yeah, I just thought I'd start sort of talking a little bit about how I compare the gold and silver bull market or developing bull market to my day job as a weather forecaster. And basically, it started a few years ago for me, seriously, with some serious sort of technical analysis and chart drawing, when I realized that there's quite a similarity between forecasting the weather and forecasting financial markets. One of the things that we do in weather forecasting, you can see on the left-hand chart there, is to gather information about what's actually happening now at the moment in real time. So off the coast of the United States and Canada there, we've got a tropical storm Kyle it is. So we can see that on the satellite pictures, we can see it on the satellite images, and it's a bit like the gold and silver market, where you can analyze where we are at the moment and where we've been over the past few years. We know where this storm started, and we have a computer model prediction of where it's going to go. So we can see where it's going over the weekend and into the early part of next week. And where I live over in the UK, you can see the right-hand map there. There's the storm Kyle. As we move towards next weekend or towards the end of the week, that's Thursday, and Storm Kyle is approaching the coast of Ireland and bringing a lot of cloud, wind and rain with it. So that whole process involves gathering a lot of information, a lot of evidence, and continually monitoring the situation as the scenario develops. We use computer models to do this. And hopefully if I could move on to the next screen, I'm going to show you how that works with the gold and silver market. Okay, clicking on the mouse, so hopefully that's, there we go.
That's me.
Okay, that's you, is it? Thanks. Oh, back a couple. There we go.
Am I going forward or back?
Go backwards.
Okay, sorry. There you go. I'll let you, because I was trying to. They have difficulty hearing you, but some people don't have difficulty. But I increased the decibel levels for you, Kevin. But
okay,
go ahead.
I'll raise my voice and see if that helps at all. So yes, trying again to move on to the second slide. See what happens. There's quite a time lag, so we'll see if this works. Okay, here we go. It's very, very slow, Patrick. I think you might need to do it at your,
okay,
at your side.
I'll move the mouse. There you go.
Yeah. Okay, so gathering the evidence in terms of the gold and silver market, these are some charts that I was drawing back in 2017, 2018, And we've got charts of gold, the US dollar. We've got charts there that show the relationship between the Swiss franc and the US dollar, showing cyclical behavior there as well. All charts are jumping around a little
That's
bit.
me. Sorry, guys.
It's working. We've got the GDXJ there. We've got the Commitment of Traders report. So there's a whole range of different charts that I sat down and started to analyze with an open mind, just trying to gather evidence and see which way the evidence was pointing in terms of, is the gold market more likely to go up? Is it more likely to go down? Same with the Swiss franc, US dollar. The chart there is strongly correlated with precious metal bull markets. And the US dollar as well. When the US dollar is falling, it tends to be a tailwind for gold. So a falling US dollar helps to propel gold and silver prices higher. Although it's worth noting, of course, that just because the US dollar is rising, it doesn't mean that gold and silver can't rise as well. The period from 2018 to 2020 saw the US dollar and gold rising at the same time. But I think the progress of gold was slowed down by the fact that the dollar was the dollar index was also rising. So if the dollar index is declining, then that helps with the rate of the increase of gold and silver in terms of dollar pricing. Okay, Patrick, if we go on to the next chart there.
Yes.
Okay, great. So looking at the big picture for gold, this is when I started to, or one of the sort of charts that I started to put together a couple of years ago. And I think it's probably about 2018 when I did this one. And we can see the broad overall pattern in gold that developed over the sort of 1990s and leading into the 2000s and the bull markets of sort of 2000 to 2011. And you can start to pick out some indications from the technical indicators, the MACD, the TRIX, and the RSI indicators. And believe me when I say you actually do not need to know what these indicators mean. It's all very interesting to know what moving average, convergence, divergence, triple exponentials, it's really, if you're into all this kind of stuff, it's interesting to know what it means, but you actually don't need to know. All you need to do is pull up the MACD, for example, and you can look at that line and you can work out just visually looking at it that when the blue line is above the orange line, it's indicative of a bull market for gold. When the blue line crosses below the orange line, then there's a change, and that change means that the price of gold is prone to dropping. Now, if that MACD line is already at a high level, as it was in 2011, and you get a bearish crossover with a blue line moving below the orange line, then the odds are highly stacked, suggesting that the bull market is over and that we're going to have several years of declining gold prices and silver prices, of course, as well. And of course, the opposite applies. So when the MACD indicator is low, as it was in 2016, you get a bullish cross with the blue line moving above the orange line, then that's indicative of a new bull market in gold being born. So that's just one piece of the jigsaw puzzle. It's not the only piece. Obviously, there are other indicators and other things to look at, but it's one piece of the puzzle that falls into place and tells you that the odds are, in terms of that indicator, in favor of a gold bull market. So the triple exponential does the same thing, and there are periods when it's clearly indicating you should get in and stay in. There are question mark periods, and there are periods when you should get out and stay out. In terms of the triple exponential, if it's rising, get in, stay in. If it's leveling off, then you could have a period of weakness. And then when it begins to drop from a high level, from a high reading, if it begins to drop, then you need to start being cautious. And the RSI indicator does much the same thing. Unless rising RSI support is broken, then stay in the trade if you're on the long side. So you can see how these support levels develop in the RSI indicator. And as long as the support levels aren't broken, then it's all good. Stay in the trade. Okay, we'll have a look at the next slide there. Are you going to try and move it on, Patrick, or shall I? Oh, there we go.
No, you're doing great. Yeah, I'm resting my voice. It's awesome.
Okay, I mean, just chip in if you've got anything to say, Patrick.
Yes.
It's, anything to add, then just
well,
say.
For the previous chart, are we still above? Sorry, if I go back, are we still above the RSI here on the monthly chart?
I'll be honest and say that I haven't gone back and checked the RSI chart. The MACD is absolutely fine. The MACD is
Up here?
performing. Yeah, the MACD and the triple exponential are both continuing to rise in a bullish configuration. It's been a little while since I looked at the RSI, but
It must look
with
good
recent
also.
with recent price action, it must be, it must have continued upwards. So I would say almost certainly it is. Yeah,
And what I've noticed here, like sometimes people say, "Oh, it's overbought," but
yeah.
sometimes you need. You see, it stayed like almost a year of that, eh? It stayed overbought there, so that's actually what I call a bull power zone when I see this.
I think the phrase overbought can be misleading. I think overbought perhaps on smaller time frames is appropriate because you get small gyrations in price over small periods of time, and perhaps that phrase is more applicable. But to say it's overbought when the monthly chart can stay overbought for, as you just said, a year, then you shouldn't be taking that fact to suggest that you need to get out of the gold bull market. In fact, if you get out of it at that point, you're going to miss the most rapid rise because, as you say, RSI being in the overbought zone, which is the wrong term to use, RSI being in the high zone is what you want. That's where you need it to be to get the rapid price acceleration. Okay, so we'll go on to the next slide there, onto the next chart. So here's another one that I sort of looked at the time, and dollar index. There are lots of different ways of analysing this, and there's a couple of charts later on. But in very simple terms, you can put the moving the moving averages on there, the 50-week moving average and the 200-week moving average, and very simply, when one crosses over the other, then it's a bullish indication. I will say though that after I did this chart in 2018. On the right-hand side of that chart, you can see the blue line, the 50-week moving average, moving below the 200, and that's a bearish indication for the dollar, which is bullish for precious metals. But of course, since then, the dollar index rallied for a couple of years, built out a bearish rising sort of triangle, if you want to call it that, rising wedge, and the indicators have been crossing over each other repeatedly since then. So we're waiting for another confirmation in terms of those moving averages for the dollar index. Okay, so we can go on to the next chart.
I will.
Yeah, cool. Okay, so really, really important in weather forecasting to acknowledge and be aware of all the other possibilities. So just because a computer model tells us that it's going to rain tomorrow never means with 100% certainty that it's going to rain, because the future isn't made of certainties, it's made of probabilities. So you have to acknowledge all possible future scenarios. If you imagine the starting point of forecasting the future, the starting point is the trunk of a tree, and then the forecast that you're getting to is on the end of the smallest branch. And between the trunk of the tree and the end of that smallest branch, there's 1,000 different forks to take, 1,000 different possibilities going off in all different directions. And the whole point of this is to try and identify which branch of the tree we're going to end up on. So in simple terms, with the gold market, at the point I drew this chart, there were three, stating the obvious really, there are three possibilities. You go down, you go sideways, or you go up. Yeah.
Is this the original annotations that you had when you did this chart?
It is, yes.
Wow,
yes.
look at that. Look at this. This is what, like, everybody probably say it's super scared right here, right? But that's when like somebody who knew about arcs or cycles or technical analysis, they actually saw that this was probably one of the greatest low risk, high reward situations, right? Or at least a try to get that number one. Because he's right, Kevin. This was a scenario. If you'd put probabilities on these, Kevin, at that moment, I know it's a while back there, but like, did you have this at 30% or 10%? The scenario number 3.
Yeah, I had number 1 at 70%, number 2 and number 3 evenly split between the remaining 30%. So it was a 70-30 sort of split. 2 and 3 were various combinations of the lower 30%. Number 1 was always the most likely. And the reason number one was the most likely, apart from all the other supporting evidence that came from all the other charts that I've shown you, at $1,200, just over $1,200 there, it was a perfect time to buy in a low risk entry, as he said, because it was bouncing off the arc, which I just sort of caught my attention at that point, around about 2 years ago, 2.5 years ago. It was bouncing off the supporting arc. The stochastic and the RSI were in strongly bullish sort of phase. So everything was pointing to number one being the outcome. But having decided that, you don't just take that for granted. You have to continually monitor and make sure that your support levels aren't broken. So that arc had to be monitored really closely over the months and couple of years that have passed since then. Okay, so on to the next. Yes. Also, before we go on to the next slide, also just look on the left-hand side there at the stochastic indicator. You can see that between 2002 is it, and 2011, it remained in the high zone all the way through, apart from the 8-year cycle low in 2008. So the stochastic fell below 50 during that 8-year cycle low, but apart from that, it stayed in the high zone throughout, and that's where we need it to be. That's where it is at the moment.
It's incredible. Right now, it's up here, right? The stock is back in the power zone for sure.
It is, yeah. It needs to stay there. It will stay there.
So the stocks pulling down, these are the buying opportunities right here in the bull market. When you go down, if I would have drawn a trend line here, these would have probably been nice buying opportunities. With one time that I would have got caught by surprise, but the other times were good chances to get in.
They are, but also look at the price chart above, and you can see that the pullbacks are actually quite small. In most cases, you're talking about, I guess, 10 or 15% in the price of gold. The miners will probably pull back a little bit further than that at times, but unless you get your timing really, really good, it's marginal on a lot of occasions whether it's worth selling your positions to try and get back in again. You end up chasing the train as it leaves.
That's the craziest thing, because now everybody's falling like in the magic pot of the precious bulls market. But after that, then people realize it's getting hard to actually navigate it, because then you're there. Okay, I'm up 20%. What do I do? Do I sell? Do I jump lower and then have a bigger position size lower? But then, like you said, a lot of people try swing trading. Only experts, I believe they're able to really grind out the additional gains, but trying to time the bottom, because psychologically, when you're gonna hit the bottom here, you're gonna think, oh no, it's gonna go down lower, and you're only gonna get back in when it's all the way back up, probably to where you exited. So it's
and it's not as simple as waiting for the bullish cross on the stochastic indicator, because when the blue line goes back above the orange line, you've already missed the bottom. The price has already retraced half of what it lost. If you go onto the shorter time frames, you'll find that the indicators oscillate backwards and forwards the whole time, in every down move and every up move. So it's not as easy as it looks. It's probably the best way of putting it, but we'll go on to the next chart and talk about that. So yeah, the gold, this is a little bit later on, I think, when I started to be a little bit more definitive about where I thought price was going. So this was still in 2018, and the gold price was, actually it wasn't much later, was it? The gold price was only $12.48. So at that point, the reverse symmetry became fairly clear. Overlaying the 8-year cycle helps. And I've noted that I was expecting bad stuff in 2023, and that view hasn't changed. So do we get this high? It says on the chart, and of course everybody knows now that we got to $1,800 and went through to $2,000. So yes, we did, is the answer to that. And the timing was just about right as well, 2020. So we've had the reverse symmetry. It's funny how these things sometimes work, I'm
getting shivers, Kevin, right now. I never knew reverse symmetry was something until I saw your charts. Angle of entry, same as angle of exit. It's and
that's right. It's a good starting point, and there's a very good reason for that, which you've shown in your charts, Patrick, which is the volume. And when you get a rapid drop like that, of course, there's no resistance created. You need trading at a given level for a period of time to create volume peaks. And if you don't have a peak of volume, you don't develop an area of resistance, then there's nothing technically, from a trading technical point of view, to stop the price rising straight back up to it's sometimes referred to as a thin zone, and that's what that's what we found ourselves in. It was a thin zone, so price went up just as quickly as it came down.
And that's why you have your arrow going back down here, because this, that's going to be probably a congestion area right here, this multi-year top. There's a couple of years, right? 2011 to 13. So that's why here we should slow down, but we actually busted through, right? We're above now this congestion
We did, and
area.
that's I think that's the rubber band effect, or the beach ball held underwater effect, where it bobs up above the surface and then goes back down again as it gets drawn back towards the moving average. Difficult one, this, isn't it? Because this is what everybody's asking at the moment. How far do we correct back, and for how long? So again, yes, probably more on that later. But you can see. Sorry, go on, Patrick. Go on.
You don't know, Kevin? You don't have a crystal ball? What's wrong with you? Come on.
I know, it's terrible, isn't it? Absolutely terrible. Weather forecasters don't get it right all the time, but we sometimes you have to use a broad brush. Patrick, we have this sort of phrase in forecasting. Sometimes the weather forecast is more broad brush than fine detail, and trying to fill in that fine detail obviously is a lot harder. But what we do know is that some kind of pullback reaction is likely after we've hit the all-time highs. That's where we find ourselves now. Although, having said that, gold miners are still very undervalued. GDX hasn't completed its reverse symmetry move yet. So something tells me that we're going to see the gold price push higher one more time to allow the miners to reach a fair evaluation. Interesting news a couple of days ago with Warren Buffett buying Barrick Gold. And I just wonder if that is going to really put a rocket up the gold miners when we open on Monday. And that could give the final surge that we're looking for. Once we have had a pullback of some description, then we're on to higher highs next year. And then the question becomes, how high do we go and for how long before we see the pullback into the 8-year cycle low in 2023? Because to get to that low in 2023, we have to start dropping at some point. So do we start dropping in late 21 or at some point in 2022?
Kevin, there's a Kyle there in the chat. He saw expecting bad stuff here. Like what? We don't know, right? So you're inferring that from the chart, since it is going to go in a cycle low, some kind of bad macro related news to gold is going to happen. We don't know what it is, right? But something's off. There's going to be a story, right, associated to the gold's drop in this cycle low.
There'll be a reason for that. Yeah. There'll be something going on in the world as it was in 2008. And I just wonder if it might be some kind of banking crisis, which may lead to a rush for liquidity as it did in 2008. Perhaps 2008 was the forerunner to what we're going to see in 2022, 2023. It sends shivers down your spine to think about it, but there's something there in the gold chart that is telling me that there's going to be a news story of some type in that time period that is going to be associated with gold falling. Well, I mean, we could be up at $3,000. This chart is a broad roadmap, but my more recent charts are suggesting perhaps something closer to $3,000, dropping back down to the breakout level around $1,800. So that's a 30% drop. Miners would probably drop 50%. Wow. That's not going to happen for no reason. So something's coming down the road. Okay, so the next chart here.
Oh, a lot here.
Yeah. Okay. So this is get back to the weather forecast, and this is the storm that is coming across the Atlantic towards the United Kingdom. This is the storm that's coming in the gold and silver market, and it's monitoring what's happening. It's monitoring your forecast, monitoring the progress, and a lot of things I was shouting about in 2018 was, for example, the HUI index, cup and handle patterns forming. We saw gold priced in the world currency unit breaking out of a well-defined triangle wedge that had been forming for nearly a decade. And at that point, I was posting chart after chart after chart showing currency after currency, the Japanese yen, the Indian rupee, the Russian ruble, the euro, the Canadian dollar, the Australian dollar, saying that, the breakout is happening. Where's all the news headlines? Where are the gold bugs? There's a massive event that was happening right there, and it went almost unnoticed.
Exactly, Kevin. I was so happy when I saw your charts. The thing that really confirmed, hey, something's happening in the bull market is when I saw that gold had already broken out or was breaking out in Canadian dollars. And then I started looking at the other charts. And then when I saw that, I wasn't the only one that saw that. Like, I saw all your previous charts with the ruby and all that. And I said, for me, it was like a crystal ball, like a light bulb in my head. Like, I'm ahead. I'm finally ahead. I get to jump on the gold express in US dollar. It was insane seeing that there, like, other fiat currencies just falling versus gold.
Now, one thing that you'll hear about sometimes is a false breakout, and sometimes in around the apex move. Our friend Grady on Twitter is coined, or one of the people that's coined that phrase, and certainly uses it quite a lot. And it's a very good point, because sometimes you can get a false breakout, as we saw in March, actually, with the precious metals, where the price was pushed artificially low and it broke below the support level before bouncing back again. And it's happened with the dollar as well, where the dollar index broke upwards to whatever it was, over 100, wasn't it? 112, 115, I can't remember now. But in both cases, it was fairly clear to me that the dollar was going to revert back to its downtrend because of where the dollar is in its cycle, and also the domed chart that I've produced that is containing the dollar index at the moment. So it was clear to me that the dollar index wasn't going to stay high for long, and it was clear to me that the gold and silver prices weren't going to stay low for long. And in fact, it was an intra-month dip, so the price didn't even last until the close of the month. In both cases, dollar came down, gold and silver went up again. And so it's monitoring all of that, and monitoring you see the silver chart on the bottom there where you've got the cursor on the screen. So, we've got two bowls there. You've got triangle breakouts, wedge breakouts, history repeating. The apex was hit perfectly as we got that drop in March, which very briefly pierced through the support of the bowl. A lot of people were panicking there, thinking that silver was going to go down to $5, whatever. It was very, very sort of clear, because of where we are in the cycle, in the precious metal cycle, and also when you take a step back and look at what's going on in the world, there's no fundamental reason to support gold and silver prices dropping. I know some people were thinking the world economy is going to grind to a halt. There's going to be no demand for silver, copper, all these kind of commodity metals. But you think about it a little bit deeper. The governments of the world are in a real fix now, and the economies are struggling. So what are they going to do? Infrastructure projects. There's got a lot of government-backed schemes around the world to get us all moving again. A lot of that's going to involve using commodities, not to mention the inflationary effects of money creation that's been going on for the last, whatever it is, 10, 50, well, I was going to say 10 or 15 years, but it's been going on a lot longer than that, but at a particularly high pace since the crash in 2008 anyway. And the right-hand chart there is the S&P index versus Barrick Gold, I think it is. So you can see how things tend to revert to the mean, and when you get Barrick Gold at a very low level and the S&P index at a very high level, then that's we're talking about low risk entry points. And if you're worried that things are going to go badly for precious metals and gold, then you look at charts like that and remind yourself that actually quite the opposite is the truth. And also, if you look at the Dow Jones versus gold charts, the ratio charts, it's very, very clear that we're at a generational opportunity for selling out of equities and into commodities and precious metals.
Stop it. Blasphemy. You can't say that to the US equity bulls. Stop it.
Well, I mean, who knows what what they can do. Perhaps they can get it up to 100,000, get the Dow Jones up to 100,000. I don't care if that happens. Gold will be $10,000 or something ridiculous. So it's all relative, I guess.
Exactly.
Okay, yeah. Next chart.
Ooh, my chart.
It's one of yours. Your turn to talk, Patrick.
Thank you for the. So yeah, in Kevin's presentation, I just added two those ratio charts I did recently that on yearly big picture, and this is gold versus the Dow versus gold, and every time we had a close below the 6 year moving average and even started below, it was a cascade of gold outperforming the Dow. So it doesn't mean you got to be careful. It outperforms the Dow. They could both be going down at this. They could both be going down, but just that gold will always go down slightly less than the Dow. Because look, you see here going down. Where's 2008? We know that gold went down 2008, but we still had red candles. That's because the Dow went down even more. So this is just this type of chart. If you would want to play that chart, you would actually have to short the Dow and go long gold, and you'd get these type of returns. That's all it means. But it also means that you're better. The equity flows are going into precious metals and gold versus U.S. equities, and this is kind of that Warren Buffett news. He was probably loading like a while back, and we just saw it in this quarter. And the next quarters, we're probably going to see more of his positioning, and then these other guys are going to probably start following him. This is this candle here. So the yearly close in 2020, we closed below the 6 years moving average. We're going to have for 6, 7, 8 years. Then that's when the cycle analysis guys, they could tell you. And we should expect a top in gold around this time, right? We could have a cycle low somewhere in between, like in 2023, like Kevin showed. But ideally at the end, that's where we're going right here. Next one, silver, same thing. So silver sucks. Silver is great. Look at that. So when silver goes down, barely no retrace. 1 year here that it was flat versus the Dow. Here it had 2 years flat versus the Dow. And already look how it's outperforming violently the Dow, the U.S. equities. And then after that, you go down to that ratio. I have a target maybe of 70 to 260 versus the Dow. So if the Dow's, 30,000 by that time, then you could do the math. I forget what it was, but it gives some nice, big, chunky, triple-digit targets for silver. But that's the momentum. That's what you have in your back here. You're just starting, guys. So everybody, every year, know that you're just at the beginning of the bull market right here. This is like, if you're following the precious metals market now, you're probably like, you didn't buy at 1250 like Northstar, who was ahead of the curve, but you're still, if you're not day trading and you're there for the long term, you're just at the beginning. Here, probably time to bail and try to think things through. But right here, like 1970 to 1980, precious metals got your back.
Got a question here from Carnivore Chef, and he's asking, do we factor in fundamental news? And I get asked that quite a lot, Patrick, and I guess you do as well. And I've said a few times that I learned, years ago that the fundamental news is there in the charts. I've said that something bad is coming in 2022, 2023 to take us down to that low. And so it's kind of the other way around. The charts point to something coming, and then the news happens to make that, to bring that about. Fundamental news, there are things that happen like elections, for example, that will temporarily swing the price one way or the other. But the overarching trend, the direction of travel, isn't affected. So it's a bit like missing a gear as you're driving, driving your car. The car will keep on going in that direction. You haven't slammed on the brakes because we haven't reached the cyclical high. The brakes will be slammed on when you reach the cycle high, and then the car will go into reverse. But news stories that happen as you're traveling towards the cyclical high, it's just like missing a gear or the engine misfiring. It doesn't really make any great difference for any period of time.
Exactly. It's noise, guys. All this stuff there. I think there's this theory out there that by the time you know the true macro driver of a move, a sustained move, it's too late. The move's done. So the chart, anyways, whatever the drivers are, we could debate. It's great for coffee table discussions, but the price action is actually the result. So whatever your opinions are, precious metals, God's metal or whatever, the printing money, it's all fine and dandy. But at the end of the day, it's what happens in the chart that counts. And
Yeah, there's one other question that I'll address later. It's from Gavin asking what our view is on buy and hold versus trading. So I think there's some charts coming up that will help to answer that question.
yes, so Kevin has a chart that you could see in a picture, like basic risk or money management in one chart. So yeah, we'll go through it later. Okay, so this is one thing that when we're right now, like we're post crisis, right? A little bit like where the VIX spiked, U.S. equities. So whatever the market had to do, the Fed lower rates or print money. In 2002, I think they didn't print money; they probably just lowered rates. Whatever they have to do to stabilize U.S. equities. So right here, everybody's fearful. Everybody thinks we're going to crash, but it's the opposite. This is actually a buying opportunity. And the precious metals, here's silver sniffing out slowly the whatever impacts of the monetary easing, whatever it is. Silver actually likes that. And the more we stabilize the markets, the more silver likes it. Inflation, the driver, etc. All the way until it's super, super calm. And that's when silver usually starts stalling. Which leads me to my second chart is where we are today. And here I have the 2008, same thing that 2002 repeats. 2008, we crashed. Right here, silver kept going up. This was the bottom of silver. Silver kept going up while the VIX was declining. March Madness. End of the world right here. This was actually a great, when it started deflating, you never know, right, when it's going to start deflating. So it's easy in hindsight saying this was the best buying opportunity. But using in the weight of evidence, you could even have waited a lot here, and even here, you still had some good entries in silver. This was before I think it exploded above 17 or 19, all the way to where we are today. Same type of scenario, VIX deflating, printing money, printing trillions, all that, inflation, monetary, silver, whatever it's pricing in, it's actually driving silver up, and gold at the same time, and U.S. equities. Often I hear, oh, U.S. equities, I'm going to short them. Look, whatever's driving silver and gold up right now, post crisis, post liquidity injection, you want to see the Russell go up. Seeing the Nasdaq, all that go up, that means you're avoiding a liquidity crunch or solvency crunch or whatever, and that's where we thrive. So me right here, there's a gap to fill. I wasn't a big gap guy, but this gap, I'm really looking at it, and I think today we're close to 20, 23. And until we gap close where we started this whole pre-March Madness, I think silver and gold are going to have a nice run up until that volatility. When it's down here, the volatility, everybody's going to think we're out of the woods. And that's probably when we have to worry down here, right? You have to be contrarian. Everybody here, end of the world. Down here, everybody to the heavens, whatever. So right here, when we close the gap at 18.1, then I want to see where silver and gold sit. Did they reach their measure move, or that 35, 29? I'm going to take a good look. But for me, we still have fuel until we reach 18.1. And okay,
great chart, Patrick. Yeah, great chart like that.
Yeah, I heard it. I didn't even know I did. So here we are today. Here I'm scared. I don't want to see the VIX go up. Here we're going to have the same thing. The precious metals are going to recuperate fast, but your stocks are going to take a hit. But if you're under leverage and you're in buy and hold, it's not the end of the world. It's just that, well, you might your stocks. Some guys are going to get margin called. They're going to have to sell, etc. But when it starts deflating again, you'll have another great opportunity to add. Right here, great opportunity to add, and all the way down. So right here until
Patrick, someone's asking if you could repeat your comment about the Russell.
Yeah, so you want to see the Russell go up. The Russell is it's a U.S. stock index where I don't think they have that many buybacks, and it's really a risk on. It's those small cap U.S. stocks, right? And usually they're the last one to go up, and they're the first one to go down. And right now the Russell chart, I didn't put it here, but it's actually breaking out, and it's trying to go up. So that's what you want to see. It looks like the silver chart or any of the risk on asset charts. So as long as the Russell keeps going up, it's risk on. It's good for silver. We're getting further and further away from a liquidity crunch or a massive sell-off in the U.S. stock markets. If the Russell cannot make a new high, then we're going to start creating divergence, and then they might start getting sold off. And that's not going to. It's going to be this big warning sign for us, maybe to be careful there with our precious metals stocks we have. So the Russell, you want it to go up, you want the VIX to go down, and you want the DXY to go down. You want the GSR to go down, but in a post liquidity event. It changes, the dynamic changes because, like Kevin says, eventually the DXY is going to go up with gold. Like the correlations, they move and change, right? So it's not fixed in stone, but post crisis, it's pretty much always the same. DXY, GSR, VIX go down, and US equities, silver, gold go up. All right. Is that, how's my sound,
Okay,
guys?
so
Does it sound good?
yeah, I'll let you monitor the questions, Patrick. I've just been answering a few
Okay.
whilst you've been talking. One more question to answer. Right. Okay. So somebody was asking about the 8-year cycle. That's in gold. So what we've got here is a dollar chart, and this shows cyclical behavior for the US dollar. And it's important to understand that markets move in cycles, primarily, I suppose, driven by human investment behavior. Why they are a fixed period of 8 years, 6 years, 15 years, up for debate, I suppose, but all I do is observe them. And if the cycle is clearly defined, then I factor it into my forecast. So if there's a proven track record of cyclical behavior, and in fact, I think some of the cycles experts are very, very sort of protective over, is it a 15-year cycle? Is it a 16-year cycle? You know, where you draw the line precisely. I'm not into that. I prefer to do it by eye. I prefer to be flexible because of my weather forecasting background. Science and nature isn't exact. It doesn't conform to exactly what you want it to do. So the cyclical low doesn't have to happen exactly on the month that you think it needs to happen, or the same for the cyclical high. But what you can do is you can step back and you can see that there's a clear pattern. So one of the things that I'm kind of hopefully quite good at is spotting patterns and spotting trends and spotting how these things are sort of all linked together. So I'll accept that the dollar history, that the sort of cyclical history of the US dollar is limited in terms of the number of cycles that are available to look at post sort of 1970s, Bretton Woods, for example, and all of that happened in the 1970s and the modern monetary system. But when all of that settled down and the dust settled, we saw the dollar forming a base in the late 80s and 1990s, from which it sort of took off and hit a cyclical high of 120 approximately. Out of that, it then dropped into a cyclical low somewhere around 70 on the dollar index. That formed a rounded base again, and then that broke out and reached a cyclical high so far of somewhere, we'll call it a round number, we'll call it 104. It spiked a little bit higher than that, I think, during the recent spike, but perhaps it didn't. That chart indicates, what, about 103, doesn't it? So the point is that the dollar sort of spiked just outside of the dome that I drew on there, but then price withdrew back into the dome. And so the chart isn't broken. There's nothing in that pattern that's broken at the moment. I'm quite prepared to see the dollar reverse and go up to 150, 160, and reassess the chart and to see what the pattern morphs into. I'm not fixed in my view that there's only one direction the dollar can go in, but what I would say is that the odds are heavily stacked into the dollar dropping into a cyclical low in the sort of mid-2020s. You'll notice that the dollar cycle low doesn't happen at the same time quite as the precious metals cycle high. You might expect that the dollar cycle low would be 2011, but if you look at 2011 on that chart, the low was actually not at that time. It was somewhere around about 2008, 9, wasn't it? So the dollar index isn't the complete inverse of gold. So that's something important to notice. There's a loose relationship between the two. When the dollar cycle is in its basing process, the gold market is in its topping process, is probably the best way of putting it. You can look at the technical indicators as well and smooth them out. I think this is the monthly chart. So you can look at the quarterly chart as well, which smooths it out even more and makes it simpler to interpret over a long period of time. But the MACD indicator there gives a very clear buy and sell signal at very infrequently. It doesn't happen very often that you get a buy signal or a sell signal. You can see a buy signal in the mid to late 1990s and a sell signal in the early 2000s, and a buy signal there in whatever that was, 2009, I think it was, 8, 9. And we've just had a sell signal that became very indeterminate, and then has also crossed in a negative way again. So the blue line is below the orange line. You can see that by the numbers in the left-hand corner there for the MACD, 2.63 and 2.77. So the blue line is now below the orange line, which is a bearish, a negative sort of position to be in.
Kevin, I'm going to interrupt you impolitely, because somebody on the chat. If we go past 86, because it is a downtrend, right? Lower lows, lower highs. Is it like that previously? I forget how it looks like before 86 there. Same thing. It kept going down, right? Since the interest rates, they started going down. It's never been going up, the US dollar, like on the long-term chart. I can't remember.
No, on the long-term chart, the dollar index is trending downwards. And the question is, will the next dollar cycle low conform to the trend in terms of what? I mean, you can see at that chart that on this chart that the last dollar cycle low, the sort of top portion of the arc is roughly level with the bottom of the previous cycle low. So the left hand arc bottoms at 76, and the middle arc has a that's right, and the middle arc sort of has its sort of the top of the basing process is in that region, and the bottom of it is down at 70. So it follows that if the same trend continues, then we can expect the next dollar cycle low to be somewhere below 70. But there are different ways of drawing the long-term trend, and there are some techniques that would show it somewhere around about 70 as the expected low, and some that would take it down into the low 60s. It's a bit academic at the moment because we need to see the price drop below the red arc, the red and orange arc that I've got there for the dollar cycle high. We need to see it dropping below whatever that level is. It's obscured by my numbers there, but it's probably around about 90. Where you've got the red dot there. We need the price to drop out of that arc. When it does that, it'll confirm that the thesis is correct, the idea is correct.
What I like about this is because of the reverse symmetry and also the distance from the arc apex. So I've noticed that if the distance here from the arc apex to the entry, usually it's the same here. And see Kevin, he has his arrow here. So for me, this signifies that the chances that we come and do a retest here, we might do it maybe on the smaller time frames, but I have a feeling on the monthly chart it's going to be barely visible, and we're going to start entering this vacuum, this thin zone, right? And
I think when we hit that thin zone, it will drop fairly well, just as quickly as it went up. That tends to be how it plays out. But as long as we stay within that arc, the dollar cycle high arc, then I've got no concerns. But time is a factor here, and we need to see the price dropping to reach that dollar cycle low, which occurs at regular intervals. Looking at the next chart then.
Yeah, there's Dominic. For the DXY, does it matter that the DXY is mostly just the dollar versus the euro?
I always go back to the fact that I'm just reading the chart. Fundamentals and why X matters or why Y matters can be debated, and it is debated a lot. And I've just put a chart up today on Twitter with the Swiss franc against the US dollar, and people were sort of saying, well, why does it matter? The Swiss franc is not it's not a safe haven currency. It's not the relationship and the ratio between the two isn't indicative of anything anymore. But it worked, and it predicted very accurately the onset of the bull market. But this chart here is just to show that, look at what I said before about looking at alternative scenarios. If you one of these is a log chart. The one on the left is the log let me get this right. The one
Yeah.
on the
Left
left
log.
is the log chart, yeah, and the one on the right is a linear chart. So on the log chart, you can see that price broke out in whatever it was, 2015, and it has bounced quite nicely off that support line now. And you could imagine some sort of process going on where perhaps the price drops, the dollar index drops down again to touch that support line, maybe in the region around 86, and then reverses and goes off up to 150, 160. You know, it's a perfectly, you know, reasonable possibility. And you could also say there's some kind of cup formation in there that has a handle that stretches from 2016 to 2020. You know, that this process, this price action between 2016 and 2020 is some sort of consolidation process. So that's an alternative way of looking at it. And also on the right-hand one there, we've got the linear scale. Price again broke through the resistance, and you know, some sort of diamond, sort of halfway pattern, consolidation pattern, some kind of, you know, there are arguments to suggest that, you know, the dollar index is, you know, fundamental arguments as well. I particularly buy into this sort of milkshake theory and all the rest of it about what's happening with the dollar supply around the world, and, you know, dollar shortages and all this kind of stuff. But
that's why it comes back to fundamentals. Don't let the fear of a theory or the greed of a theory that matches your bias influence your trading. Let the chart do it, because that milkshake theory, it could scare a lot of gold bulls to sell their positions early, or dollar shorts to sell the position early. But listen to the chart, because the chart will tell you if this milkshake theory is real. And maybe it's real, but maybe it's not the amplitude that everybody thinks it is. Like, maybe, okay, we had the milkshake theory, but it just accounted for like 5-6 points on this chart, you know? Often our imagination goes wild with news and tweets of somebody saying something doom and gloom, you know? But at the end of the day, just look at the chart and...
the only truth is in the price action,
yeah.
You know, so theories count for nothing in the face of price action. You can hang on to your theory for as long as you like, and goodness knows Henrik Zerberg has been hanging on to his theory for way too long. And he's missed out on the entire move from $10.50 to $2,000, and you know, could have doubled his money, tripled his money. In fact, if he bought Kirkland Lake, he'd be a millionaire by now, and we all would. Anyway, moving on to the next chart.
We're gonna cover, right, where gold can correct. The Tango asked a question: where could gold correct? We're gonna deal that at the end, right?
Yeah, we'll deal with that in the last couple of charts. Okay. We'll try and. So this is the Swiss franc US dollar chart, and I think I've updated this one today. And okay, it is what it is. You know, you look at the chart, and it doesn't matter what people say about it. The chart is saying what it's saying. What it's saying is that, you know, the Swiss franc and the US dollar is in a steady uptrend defined by a channel that has very clear geometric properties. You know, depending on the scale that you draw it, of course, the angles are different. But drawn on this scale, it's a 14-degree angle of ascent. So you have a support and resistance lines at 14 degrees to the horizontal, and at 27 degrees to the 27 degrees to the horizontal. At both of those time periods, you know, during the late 90s and going towards 2002 there, and also more recently between around about 2012 to 2018, price was contained by that 27-degree angle. And it is what it is. You know, price is conforming and respecting those support and resistance lines. And as long as the price is telling you that those lines are important, then those lines are important. And history tells us that when the Swiss franc US dollar ratio bottoms, then that is the bottom of the gold bear market. When the Swiss franc US dollar rises out of that basing pattern, then you can say with a high degree of certainty that the wind is in the sails for the gold and silver market. What you can't say is, looking at this chart in isolation, you can't say this tells us there is definitely going to be a gold bull market for the next 10 years. It doesn't tell you that. It's one piece of the jigsaw puzzle, and this piece of the jigsaw puzzle is telling you that there's going to be a gold bull market for a long period of time in the future.
Kevin,
the other pieces tell you more.
Hold on, there's somebody that wants us to pause the stream because they're opening their trading account and they want to go long Swiss franc versus US dollar. Can we wait for them to do that?
Well, I wish I'd sort of seen this chart, a couple of years ago.
It's
But
beautiful.
It unless the price action breaks the support line,
Yeah.
closes below the support line on a monthly basis, then the chart holds true, and that's all you can say with any of these charts. The price, the lines, support and resistance lines, and the arcs are there for a reason. They're not just imagined in your head and my head. They're there because the price is bouncing off of these lines. Why? Why does the price, respect an arc? Well, because over a period of time, the selling reduces. And I guess the selling reduces in a way that decays over time. It's a natural decay. As sellers step away from the market, or perhaps I should say, as sellers are exhausted, then the rate of decline of the drop decreases. So that naturally forms an arc. Why it bounces so cleanly off an arc or off a support line, I guess that's down to human traders and also the computer programs that are programmed to trade, automatically will also be aware of these support and resistance lines. So, buys and sells go in at those points and further reinforce the price action. Anyway, all of that is kind of beside the point in a way. The MACD and the TRIX indicators are in a bullish configuration. Price has bounced out of the arc, it's rising, and it's bounced off of the support line. So that chart on its own is supportive of the theory that we're in the early stages of a prolonged precious metals bull market. Okay, yeah. So on to the next one.
I love that chart.
Okay, so somebody was asking earlier on, are we going to touch on cryptos? And I've got this chart here for Ethereum. It could just as well have been Bitcoin, Litecoin. It could have been one of a number of cryptocurrencies. They tend to be quite closely correlated most of the time. Although I noticed one of them today had gone up by over 100% in a day, which Orchid, I think it was. In fact, I think it had gone up nearly 200% at one point today. So these things are volatile, but again, they respect the same rules. Here's the arc for Ethereum. It's been, building out for over 2 years now. Price has bounced off it on the left-hand side there. It's bounced off it on the right-hand side. So that arc, which is geometrically perfect, means something. Whatever your view is on these things, that arc does mean something because the price has hit it and it's reversed, strongly and convincingly. So we can take it as read that the arc is going to provide support into the future. It also helps guide price upwards and gives us a time frame for various price targets, just as it did with gold. And we were able to identify how high was gold going to go and over what time period. Then with Ethereum, there's a strong suggestion here that price is going to reach the $800 level before time runs out to reach that $800 level. So we're looking, by the end of December to see price rising to that $800 bracket. And by the time we reach the end of the arc, which is only February next year, we've got $1,400. So sometimes you do see price dropping out on the right-hand side of the arc as it starts to form a sort of a handle formation. So once we get above $800, it's possible that the right-hand side of the arc could be violated to form a handle that pulls back for a few months before price continues to advance. But the same is true with Bitcoin at the moment, and Bitcoin's forming the last time I looked a day or so ago, it was forming a bullish pennant, which indicates an imminent break to the upside. So why are cryptocurrencies and precious metals correlated? Same reason that all the commodities are correlated. It's a cyclical process, and also it's an antitrust trade, isn't it? It's where people take their money out of the bank, out of paper currency, and put it somewhere where they think and feel they have more trust and more safety. And so when faith is eroding in central banks and paper currency, then cryptocurrencies is another place where people will park their money, and in the shares of commodities. And something I haven't mentioned here is things like uranium, for example, which is at a generational, or has been at a generational low point in terms of uranium miners. So if you're looking at gold and silver miners, you certainly should be looking at a very small percentage of your portfolio being in uranium miners. I say very small, that's up to you, but they are very volatile, but potentially could make you quite a lot of money. Okay, so on to the next chart.
This chart's beautiful there. The second test of the ARC, guys, if ever you want to know if your ARC's valid, this is perfect, and you need a second test. So don't gamble. This is the first test, you wait, and the second test and the bounce off, look how powerful that bounce off was. That is like go, go, go. Don't like, but it's a good signal for that.
It is, because if you hadn't had that second bounce, then you can pull the arc to the right, and it is still touching that other point in 2020. So you can extend these arcs sideways to the right by months or even years in some cases, depending on the scale of the arc, and you suddenly realise that the arc's a lot bigger than you thought it was originally. So, like you say, you do need that second touch on the arc. I think somebody was asking on the live chat about investment decisions and cycles and that type of thing. So if one of your questions is around how to invest in all of this and where do the cycles come from, some of those questions are answered on here, because the gold miners and gold and silver have a very regular heartbeat, and the heartbeat goes up, it goes down, it goes up, it goes down on a regular cyclical basis. I'm not going to answer why that is, because that's open to a lot of debate, and my answer is no more valid than anybody else's. But it's just it's a fact that it does do that, and it can be, you can identify it on the charts, you can see it on the charts, it's there, it's real, and it's been going on for decades. So on this chart for the GDX, the GDX chart is the GDX chart, isn't it? Yeah. We've got a couple of the cycles are indicated there, with a cyclical low in 2016, and because it's an 8-year cycle, well, it's 2015 actually was when it sort of started to hit its low. The next one's going to be sometime around about 2023. So that's where we're expecting the next major drop. And of course, we get pullbacks in the meantime, as we've seen recently, but the pullbacks are much shallower than the one that we're expecting to see that takes us down into 2023. So step one is deciding if you're going to try and, this is on the assumption that you've already got a position in gold and silver miners, is whether you're going to try and take advantage of the 8-year cycle low. That's entirely up to you. It's up to your risk appetite and how much you want to sort of try and trade. I think I'll probably be taking a fairly aggressive approach on this. I might keep a 50% core position and try and trade out of the market with the remaining 50%, which is perhaps quite a lot as far as some people are concerned. But we'll see. We'll see how it goes, and we'll see how I'm feeling as the time approaches. So yeah, you will look at the amount of money that you've got, and perhaps keep a core position, and then as we move up into your target area, which for me is somewhere between, well, I've indicated there, between 52 and 68, and you start selling in kind of chunks. You might want to sell in 2, 3, or 4 chunks, and you make that decision around at what point you're going to sell and at how much you're going to sell at that point. In this example, I've divided it up into 4 equal parts, selling $1,250 out of a total of 10,000. So that by the time you've finished, you've sold 50% of your position and taken advantage of the peak, which we're expecting to see as we move into the through next year and perhaps the early part of 2022. So we'll be monitoring, or I'm sure Patrick will as well, and others on Twitter will be monitoring the progress of the gold miners as we move up over the next 12 to 18 months, trying to sort of find out and get indications as to where that peak is going to be and when it's going to be. There are cycle analysts on Twitter and Gold Tent as well who will be giving their views and opinions. Something to notice is I've got on there that's just how far do we need to drop at the moment? Do we need to test the $30 support level, or is the bull strong enough to continue upwards from the level just below $40 where the support line is at the moment on that upper rail? My feeling at the moment, yeah. Sorry, Patrick.
Sorry, just interrupt. The low of the cycle, it doesn't mean it goes down at $8 the chart, right? It just means it's a low in the cycle. You could be making higher lows, and it still be considered a cyclical low.
Oh yes, I've just put a label there to show that is the time period where the low will occur.
Exactly.
That's not meant. It's not meant to indicate that the low point is going to be down there. I would expect if we get up to, shall we say, if we get up to $60, I would expect to come down and perhaps retest the horizontal breakout level at around about 32 level. So that's best part of 50% drop in the miners, and that's based on what happened in 2008. So that's not set in stone. It could be a 20% drop. It could be a 30% drop. You know, I suppose it could be a 60 or 70% drop, God forbid, but I don't think it will be. It's a case of being mentally prepared, and you know, I'm mentally prepared for a large sell-off there. Whether it's, as I say, 20%, 30%, or 50%, only time will tell, and we'll probably have more of an idea as we approach that time.
Kevin, this is the cycle. Okay, the cycle is 8 years, but the secular bull that started, or let's say, like, are we having 2 8-year cycles, one after the other?
Yes, that's right. So it's a full 16-year cycle that's going to take us until late 2020. So we're going to bounce out of this. It's actually a mid-cycle low in 2023. So the 16-year cycle started in 2015/2016, and that takes us all the way to sort of 2031 to 2032. So the next 16-year major cycle low will be between sort of 20, or shall we say 2030, 31, around about there.
Okay.
And then that means, of course, that at some point we have to start dropping. So I'll explain more on one of the next charts. So we can go on to the next chart from here, I think.
I love the red cursor. I'm like a cat following a.
It's like an asteroid shooting across the screen, isn't it? It's like, so one of the things, probably like most people, I've got my finger hovering over the sell button every time there's a 5 or 10% drop, you know, and I'm thinking, do I get out? Do I sell? I've sort of refined my kind of techniques over the last few years, and I'm now sort of not invested in 30 or 40 stocks like I was before, because it's very hard to keep a track on 30 or 40 stocks, you know, a whole portfolio of loads and loads of gold, silver, uranium stocks, whatever. So I've reduced my number of stocks that I hold to probably somewhere more like, I don't know, between 15 and 20. So it's a bit more manageable when it comes to looking at the individual charts. So we've got America's gold and silver on the screen here. The big picture on the top left shows that this isn't really a time that you want to be selling. Why isn't it a time you want to be selling? Because the price has literally only just made the breakout, and you don't sell breakouts, you buy breakouts. So yes, it might be a bit scary if the price drops from $4 to $3. That's a 25% drop. But just look at the scale on the right-hand side. $4, $3 is nothing when you compare it to $20, $30. So, you know, you can be scared out of your position. You can, you know, suddenly find that price starts accelerating, and it may do this on Monday. You know, I mentioned before that Warren Buffett has bought, Barrick Gold. Who knows what that's going to do to the gold and silver mining shares on Monday? We could suddenly see a 10, 15, 20% rise in some of these mining companies. Your guess is as good as mine. But if that was to happen, wouldn't you feel terrible that you just sold to try and avoid a 5% pullback?
Well,
or even a 10% pullback, you know. So the time, you know, this isn't really the time on this particular chart anyway. I'm not tempted to sell. I'm quite prepared for price to come back, and as you can see on the right-hand chart there, it's actually tested the breakout very nicely. So it's a classic breakout with a gap, consolidation, back test with a mirror image gap. So this is strongly suggestive to me that we're going to see an advance. And you look at the TRIX indicator and the MACD indicator, and they were aligned with the price drop. So that was positive divergent. It wasn't negative divergence, it was positively aligned with the price action. Price was falling, the indicators were falling. If the indicators are going in a different direction to price, then that's negative divergence, which over a longer time period is indicative of a move in the opposite direction. But in this instance, what we're looking for now is a breakout of the TRIX indicator and the MACD indicator, which looks highly likely. And it's looking highly likely to me that this particular stock is going to rise in value.
Very nice.
Okay, yeah.
It's like, I know like about around the apex move, but since like we're in a precious metals bull market and gold's like above all-time highs, the chances of actually this going around that breakout and breaking down, it's a lower probability.
It is a lower probability, and if we do get a shakeout to the downside, then that's not going to concern me either, because I'll just hold my position. And for all the reasons that I've already mentioned, you know, gold and silver miners are way undervalued. Even if gold goes back down to $1,700 an ounce, the miners haven't even priced that in yet, let alone $2,000 an ounce. This is Gold Standard Ventures. And Gold Standard Ventures, sometimes, you know, I said to you, Patrick, a couple of days ago, you pull up a chart and it's a joy to analyze. And sometimes, well, this was one of those charts. You know, there was such a lovely pattern, which a very clear, regular heartbeat to this particular gold stock. And it's risen from 2010 with a 550% gain. It then dropped in an expanding falling wedge, hit the horizontal price support level, and then went up 800%. It then hit the upper resistance level and dropped in a horizontal expanding wedge into the next cyclical low. So that's where we find ourselves now. We've risen from that cyclical low from, what was it, 0.45, 45 cents, and we've tripled in price more or less to 120. Okay, that's great, but you know, if price breaks out from here, we're going to go from 120 to, what's that, $6.
Yeah,
so you know,
about
another 500, you know, another five-fold gain to give us a 1,200% gain altogether. And then the next cyclical low comes up, and you would expect the whole pattern to repeat. Why is it doing this? I don't know. I can only describe it as a heartbeat. It's a, you know, you find these things in the well, it's not just gold stocks, silver stocks, but you know, you can look at you know, stocks in the Dow Jones and S&P 500 or whatever, you know, the uranium. But it seems to be that in precious metals markets, you do get these very clean, clear investor-driven cycles and patterns. And a big picture for GSV, Gold Standard Ventures, well, it's a rising channel that we've been in since March of this year. And you can see that just over recent sort of weeks, we've been forming some sort of consolidation pattern. It could quite easily just drop down to the lower support rail, which is around about $1.10. And that would be a really good buy area if it were to get down to that sort of level. But we're talking peanuts here when you look at the overall possible upside. So, you know, I don't sort of sweat the small stuff when you're looking at the bigger chart. Just take your position and hold on for a hell of a ride. Okay, yeah, so the next chart.
Ooh, this one I like a lot.
Okay, so this is the last couple of charts, so we've probably been on longer than we thought we were going to be, but this is the developing roadmap for gold, which I did this morning. And I've tilted the arcs on here. You can play about with the geometric patterns on TradingView, or you get the same charting software on goldprice.org or .com. I think it's .org actually. But by tilting the arc, you get a slightly different perspective on things. The upper resistance line of the arc is now tilted at an angle, and interestingly, the entry and exit of the price action still follows that arc formation. So what have we got here? We've got a wedge formation during the 1990s, which broke out, which also had to be a breakout at the apex of the arc. you want to call it an apex. And then price, went skywards all the way into 2008. That was the cyclical low. You can see down on the bottom there, I've put the 8-year cycles on there, and people are asking about the cycles and how you can justify that they're there. Well, if you look at each one of those low points in the cycles, so each one of those semicircles at the bottom of the chart is a cycle, and the bit where you've got the cursor there, those are the low points. And if you look upwards at the price action, you can see that where those low points are, the price dips. Think of it like a magnet. The cyclical low is like a magnet wanting to attract the price downwards. So in 2000 to 2008, the price went upwards. We were in the uptrending part of the 8-year cycle. It was a right translated cycle, which means that the price rose all the way through that cycle to 2008. It was only at the very end of that 8-year cycle that price dropped. So that made it a right translated 8-year cycle, with nearly the entire cycle being made up of price going upwards. So we got into 2008 and the price dropped very sharply back to the pullback zone, and the pullback zone was the previous high from 1979, 1980. So price pulled back to approximately $500, just above $500. So we fell, a long way into that low. In fact, it was almost what, 50%, wasn't it? 1,000 down to. So down to 650. I'm just reading the chart. So so you're talking about 30+% correction.
The right translation there, it's like it could really, really edge the edge, right? It's like
you'd be thinking at that point, where is this cyclical low? What's going on here? The cycle seems to be broken, but then, wow, the bottom fell out there. 30% drop in the price of gold in no time at all.
And that's something I've learned there when I was doing cycles at the beginning. I was trying to match the highs. Big no. You match the lows. So it's the lows that count. And if those match, then that's the cycles are good.
Yeah, you can try and match the highs as well, but you find that they vary in time length between the highs, depending on whether it's left translated or right translated. And this is a question, of course, we're asking ourselves at the moment, because on the latest cycle, as we've come out of the later, and you have to also bear in mind that this is a log chart. So the arc on the latest arc on the right-hand side of this chart looks quite small, but that's because we've got a compressed scale. So the price difference from the bottom of the arc to the top of the arc is probably larger than it is for the arc on the left-hand side, but that's all just because we're using a log scale. And log scales, by the way, are more appropriate over a longer time period. And the reason that they're more appropriate is because all of this appreciation, if you want to call it that, in the price of gold is happening at a logarithmic pace. It's happening at a logarithmic pace because the creation of our monetary system, the new printing of money, is happening at a logarithmic rate. Just take a look at the US debt, accumulated debt at whatever it is, 23 trillion. It is moving at a logarithmic, how can I phrase this? It's moving at a logarithmic rate. So it figures that anything that is priced in that currency is going to be reacting logarithmically. Over short time periods of a few weeks or a few months, you can analyze the charts on a linear scale, and the support and resistance lines will obey the linear chart. But on a log scale, you get a much better view of the long-term price action. So what we're looking at now is how right translated is this latest cycle going to be. We know that the cycle low is in 2023, but how close to that low point in 2023 do we get before the price starts to pull back? We've identified some targets moving out of this arc, which I think should be achieved before the 2023 low. So I'm looking at silver somewhere above $35 and more likely around about the $50 to $60 mark. So I think perhaps $35 is achievable in the short term this year. And then I think $50 to $60 next year, we will probably have a pullback continuing over the next few weeks. There could well be an upwards price reaction tomorrow following the news over the weekend. But I still think that we're highly likely to see a larger sort of cyclical pullback in the next few weeks that sets us up for a more sustained move to $50 or $60 silver and gold, getting close to $3,000 next year.
It's like as much as I want silver like to skyrocket to like infinity and beyond tomorrow, I know that pullbacks they're you have to like embrace them and see them as add-on opportunities that don't come on often. Like on the way up, you might in a big bull market, like great opportunities to get in. You might get 2, 3, 4, 5 chances, max to get on. So the pullback that we're happening now is probably great, and then probably the next one after that, it might be that 2000. Well, maybe there's gonna be one more or two, and after that, the next great one is gonna be that pullback into 2023 there for PMs there to get on board. So
yeah, I mean, so silver is very, very volatile, and what's to stop silver going to $30, $35 in the space of a few days? It could do that. This is where we have to adjust our roadmap. We know the direction of travel, but we don't know just how hard the accelerator is going to be pushed. We know that gold and silver have been held back, and they've been held back by the central banks and the COMEX and all of the shenanigans that go on. And I think price discovery is just starting to take place now. This is the silver chart, and it could turn out that the targets here are too low. If money printing is not limited, then the price of gold and silver isn't limited. So for me, it's a question of how quickly and when is control properly lost. When do we get to the stage where you can't get gold at any price, and silver is so all of this is up for debate. But at the moment, this is the working sort of roadmap. But will be the destination. If you want to put it that way, the destination might not be the moon. The destination might be Pluto.
Look at this, man. It's crazy. Like the MACD just turned up.
Yeah, and looking at the shorter term charts, people are thinking, well, we're overbought. We've gone too far. The elastic band is too stretched. But when you look at the quarterly charts, we're not even started yet.
You're right here. You're at the beginning.
Yeah, right at the very beginning. Yeah. So, this is one enormous cup and handle pattern, and the arc, the small arc on the right hand side there. If that is a handle, as shown by those solid black lines, if it is just a handle rather than needing to be an arc, then price doesn't need to come back and retest the right hand side of that arc. Conventionally, you would need another test. You can see the larger arc has been tested multiple times on its right hand hemisphere on the right hand side, but this smaller arc, if the handle pattern is what it looks like, then silver price, there's nothing to say that silver price does actually have to come back and test $26 or $30. It could just go, go up.
Like 1970 style, something.
It could. I don't want it to, because if it does that, you're going to burn out.
Yeah,
I don't see the burnout phase until after the 8-year cycle low. I still think that we go into the 8-year cycle low with lots of fuel in the tank. So if we get to $50, if we get to $35 next week, I'll be concerned. If we get to $50 this year, I'll be concerned.
Yeah.
This is where you start to question what the hell is going on if that happens, and
Well, I wanted the silver to. I'd like just silver to close a solid close above 31, 32. That's where 131 is where I have my yearly defined resistance.
Well, so if that happens, then we're all going to make a lot of money in the miners. The miners have not priced in
that's
$30
the questions.
silver we're getting results now, profit results from some of the miners, and they're fantastic. They're printing money now. If gold stays above $1,600-$1,700, if it just does that, and if silver stays above $20 and just does that, the miners are printing money. I mean, fuel costs are low. One of the biggest costs of all.
There's always a lag, guys. Go back every time gold metal broke out. 3 months, 6 months later, the miners broke out, and silver, same thing. So if silver broke out just this past quarter, or this past 2 months, give time for the companies that have better earnings per share, whatever, like the fundamentals. This price, if it stays around here, definitely the miners. So we'll have.
And why do you think Warren Buffett bought Barrick Gold? It's not because he likes Barrick Gold. He knows what's going to be happening with the profits reports of these gold and silver miners. This is where we're going to see mergers and acquisitions. Explorers will be, ripe for being bought out. We're going to see some incredible price appreciation in the juniors and the explorers, particularly in the silver space. So the gold silver ratio is still, what is it, 70 or more, isn't it? From a historical perspective, it still has the gold silver ratio still has a long way to fall, which means that silver is going to outperform gold, which means that silver miners are going to outperform the gold miners. They're all going to do well, but until the gold silver ratio gets down to 30 or less, then silver will outperform gold. When it gets to 30 or less, it doesn't mean that the bull market is over. It just means that the gains going forwards will be equally spread between the two. So that'll be something to look at more closely when the GSR gets lower.
It's like I talked to Kevin there yesterday, and I was in 2009 when the market started awakening. I saw above the 30-week moving average, etc. I was long stocks. And then as soon as I had a 2-bagger, I was so happy. I sold, 2-bagger, I'm going to sell. But then after that, 1 year, 2 years later, I looked, the stocks that I sold, they were 8, 10-baggers. So I tried to remember that. So that's experience, don't go greedy, Pat. Still listen to the charts. But remember that the big gains is buying right, like here at the handle, buying right and sitting tight until the chart tells you that it's time to go. So if you're not over leveraged,
don't get scared.
Yeah, it's as long as the chart you're above an inclining 12-month moving average or 30-week, and the technicals look good. When you're most fearful, it's usually in the bull market. It's probably the time to add on, or if you're already fully allocated, then you just wait. Don't because like the cycles, all the evidence, all we're showing you today is just to show you all the accumulated evidence for this PM that got me on board, that has Northstar on board way before me. It's not we're gold bugs. The evidence, this could have been cannabis or something else. If we would have seen this type of evidence, we would have been bugs of whatever the product was, right? And we're
it makes no difference. It could be, if it was the Dow Jones, if it was the S&P, if it was Apple, it was, just, go with the chart. Just believe what the chart is telling you. If the only truth is there in the chart. You can argue and debate the fundamentals and what's going on in the outside world, but funny things happen in the outside world and things that you don't expect. And, stuff happens all the time that, contradicts what you thought was going to happen in the real world. You put your news channel on and something's happened and that has an effect on the price. But all of that is in the chart. It tells you what's coming. It tells you what's happening. It tells you when to buy and it tells you when to sell.
Exactly. But just before we end up, that was the last slide, guys. We're already an hour and a half in. Kevin, it's like midnight in England right now. No, I'm kidding. It's not that late.
It's getting late though.
It's getting late. And but that's it. Precious metals are like a store of value. So even if the Dow goes to 100,000, well, gold is going to be 70,000. It's gonna preserve your value, right? So you got to measure stuff in other than fiat to see the true value of something. So
I hope this has been useful for everyone. I was saying to Patrick, it might be an idea to maybe do this on a bit more of a regular basis. We'll have a think about that and maybe come up with something. But if people like it, then sort of let us know and we can do some more.
Yeah, really appreciate you guys showing up, and any positive feedback, good, negative, keep it for yourself.
I'm sorry. I apologise if we haven't been able to answer all the questions, but
I think we did
I'll,
good.
I'll,
We
I'll,
did
I'll
good.
go back and read them, and if there's anything I can answer on
Yeah.
Twitter, you can get us both on Twitter and
Yeah.
answer on there as well.
Cool. Thanks, Kevin, for doing this with me, and it was super cool, guys. All right, that's it. Ciao, ciao, guys.
Bye bye.